So you've been wanting to research companies, but you don't necessarily have the time to do it yourself, or you don't know how to do it yourself. In this series of videos, I'm going to be going step by step through my entire process from beginning to end on how I find companies, what I look for when I do my initial research on the companies, if they pass my initial research, how do I value and evaluate them after reading their financial statement. I will go step by step, including valuations when we get to that point, in how to evaluate companies. My name is Jason Rivera, and welcome to Value Investing Journey Case Studies.
Call. So 149 million. What is that? Uh, 8.7%, not bad. So that's an average of about, over the last 10 years, what, 8/10%, 9/10% of the last 10 years. That's not bad. Book value per share. $10.35. So 25.2. 25.2%. What does that mean? That, because I don't know if we've come across this before, what does that mean that book value per share is rising faster than the share count is rising in the same time period? Or what is that a sign of?
I'm not sure if they're diluting shareholders, but I'm not sure how the share count increased anyway, but I would say.
Yeah, just guess, because I don't think we've talked about this before.
Are they retaining the earning for the book value to increase? Or maybe that's one.
Sort of. It essentially means they're increasing the underlying value of the company faster than they're diluting shareholders.
Oh, okay.
Does that make sense?
Yeah, that's a good thing.
This is why I put both of these here. Is not only to see if they're diluting shareholders, but to see if book value is either rising faster, slower, same rate as they're either issuing or getting rid of shares or keeping shares the same, to see if book value per share, or because book value per share, remember, is kind of the very basic level of what the company's worth. So,
by the way, you haven't recorded the screen. Do you still want to record the screen?
It should be recording everything now.
Is it? Okay. Well, I don't see usually when you're recording, I see a record sign on my end, but I don't see anything.
Let me make sure. Here. Make sure. Yeah, it says pause recording or stop recording, so it must be recording everything now.
Oh, okay.
So yeah, no, that's important because we haven't talked about that before. At least I don't remember talking about this before with you. So that's a nice thing to kind of catch when you do this preliminary analysis worksheet. Okay. ROIC is 7.8% rounded up. So 6.2% rounded up. So they've been increasing their margins, correct?
Mm-hmm.
In the last several years. What do you remember what this being higher than this means automatically?
Leverage? I don't know.
Yeah, the company has debt.
Yeah. It's pretty poor return on equity.
It's a manufacturer, though. You kind of have to expect it. Manufacturer and developer.
Yeah.
So 6.6%. 1, 2, 3, 4, 5. So their return has been rising there, which you would expect since ROIC has been rising over time. Free cash flow to sales. Ooh, that's interesting. Why is that interesting to me as soon as I saw it?
Free flash card.
Do you remember?
So for every dollar worth of sale, 15.6 cents goes into free cash flow.
Yes, and what's the number I look for here that's considered to be a kind of a cash flow machine company?
You said more than 10%, if I remember.
5% on this one.
5%?
Yeah.
Oh. Yeah, but that's because last year's been really high. I mean, on average, it's not going to be.
Well, the average is 10.8% actually over the last 5 years too. Okay, so quick look here at the balance sheet. What's the first thing you notice on here?
The cash and short-term equivalent, it seems to be going down. So I think they're funding. They bought out an American subsidiary, and they sold off some the debt, and then they sold off a small stake in the what's it called? They started selling off shares in the Washington's Patterson, so it's acquisition.
Yeah. Percent. Trailing 12 months, short-term debt. .3%. That makes sense.
Oh yeah, because cash and cash equivalent is. Yeah, that makes sense. Yeah. So that's just literally takes the cash and then you subtract the debt.
Yeah.
That's exactly what you're doing. All right. Okay.
Yep. And the only reason I do this, I make notes of this every time I do it, is because I want to know later on in the analysis if the company has a net cash position or a net debt position. Because obviously, if they have a net cash position, that gives them a stronger balance sheet. If they're in a net debt position, that gives them a weaker balance sheet.
Yeah, that makes sense.
Okay. Anything else catch your eye here that you want to talk about?
I'm trying to figure out where the hell they account for the equity stake in the other company. It should be the other long-term asset. Yeah, that one.
Yeah, this makes up almost 62% of their entire balance sheet.
Yeah,
so I can guarantee that's where it is.
Yeah, got it.
Okay. Cash and cash equivalents. This may matter depending on how big of a portion of their brick and their manufacturing side of things, how much of a percentage of their business this takes up.
They actually make more money from developing than manufacturing. But most people think the company called Brickwork.
Yeah.
you think it is make break, right? It does, but it doesn't take. You look at the income statement; it actually constitute a lower percentage of the income. Quite interesting.
Okay, EV. Do you remember how to calculate that? Because I'm gonna have you do it.
Oh, yeah, enterprise value. I have it written down somewhere. I can find it. Is it the one where it's like short-term plus long-term debt, take away? I don't know.
Yes. So I'll make it working. Minus cash and debt. Most of the time you just kind of disregard these because most of the time companies don't have these. That's the actual calculation right there.
Okay.
So market cap is 25 or 2.5 billion. So in millions, it's like that, minus cash and cash equivalents. Again, I want to make sure we have the most recent data over here. So 21 plus short-term and long-term debt. No short-term debt. Long-term debt is 324. I'm not going to do debt equivalents here because we'll have to dig into the balance sheet, and we'll do that later. So preferred stock, minority interest. I don't see any preferred stock, minority interest. Zero plus 0 equals so 2803. What does that mean that that is bigger than its current market cap?
But one sign that it could be potentially overvalued.
Yes. Correct. So this company, if I remember right.
Which makes sense when you have that much debt on this.
Yeah. So we can't do the EV to EBIT calculation because they have a negative EBIT.
Have you had that happen before?
Yes.
So what would you write it as just not applicable?
Because EBIT is negative. Okay, free cash flow. 127. Divided by 127. So 22.1. What does that mean to me?
It looks like overvalued. I think you want something less than 15 on that.
8 or less on this.
8?
Yeah, that's what I look for.
Oh, like less than 8, right?
Yeah. And this hopefully illustrates why, because I'm not happy with the 4.5% return over the next year. Essentially, that's what this is showing right now. And this is actually negative. So based on these numbers, I would not continue my analysis of this company. But because you said this is an interesting company with a kind of different dynamic, I want to keep looking at it.
I think the whole premise of this company is it owns like 40% of the other company. That's, I think, the only value in this company.
Yeah. And that's where we will find.
It's in the news and report. Then they go to annual report in June.
That's weird. It's usually in the investors section. Okay. Blah, blah, blah. Don't care about this stuff. So on here, they're showing an EBIT of 279 million. If these are in millions, yes. So what happens, what do I do when this is the case? Morningstar's numbers and the annual report's numbers are different. What do I do?
Look at the annual report one.
Yes, because those are actually audited numbers. Change this information. Figured it'd be 10%, but just want to make sure what the decimal was. Actually, it's rounded up 10%. Oop, wrong one. 10. And this is 9.99.
That's right. Right it up.
So what do I do when these numbers are so far off from each other?
They look. I don't think the EV/EBIT. I think you were looking for less than 15 or something like that.
I look for less than 8 on both of these.
On both of them.
Yep.
So these are two signs that they could be overvalued.
Yes.
All right.
So what would I do if, say, this was this number and this one was this number? What would I do here?
You would look into the company more?
Yes.
Right.
Yes, which we're going to do anyways. So.
Interesting. So I guess from an earning point of view, this company is a letdown.
I would say more from a free cash flow perspective because it's reasonably close on the EBIT perspective to what I look for in the 8 or lower. But on the free cash flow, its free cash flow isn't keeping up to its operating profit. What could that mean? Do you have a guess on what that could mean?
They're not using capital intensive, maybe the business capital intensive. Maybe
Yes.
they're not. That's what I'm guessing.
Perfect. No, that's exactly what it is. They have to put a lot of capital expenditures back into the business.
Yeah, it's a brick. If you look at it in the report, they manufacture brick. Like that's actually what the business do, and they do like anything to do with brick. You know, the color bond stuff.
Is this what you're talking about right here?
Yeah, they do pretty cool stuff, but probably not the best from a free cash flow point of view. It's not going to be like a financial transaction company like Visa or some shit, you know. It's like,
yeah.
But if you go down to the 42.7% stake in WHSP, that's now about 39.3%, and the market cap of that company is about 6.3 billion.
Okay, so we'll calculate that out. So is this company public, or is this one of their subsidiaries?
That's a subsidiary.
Okay. So they own 50. Do you know what this means? They essentially own 50% of this company that has assets of more than $1.5 billion. So they essentially own $750 million worth of assets related to this subsidiary.
Yeah, right. I'm not sure how that's accounted for on the balance sheet, though.
Yeah, and we'll look, because if it's their subsidiary, it depends. When it's a 50% owned situation, they can either consolidate it. To my understanding, they can either consolidate it or kind of break it out. Most people tend to kind of consolidate it. So we'll see what they do. So right now, so you said this is about 39.9%?
39.3.
39.3.
Last time I looked at the recent, if you go on the ASX website, it's closer.
Okay. So, and that's about a $6.3 billion.
Yeah. I'll double check now. Yeah, the market cap is 6.3 billion of the other business, SOL.
2.48. Okay, so let's stop here because this is important. What does that mean? I'll write it out. Is it BKW or BWK?
Brickwork. The code?
Yeah, the ticker.
I think it's BKW. BKR, okay. I think. All right, let me check. And the stock code for WHSP is SOL ASA. Do you want to be more specific?
Yes. Okay, so what does that mean to you? That those two little sentences I just wrote. What does that mean?
The market values BKW's subsidiary or the company they own as like at nothing. It doesn't value like it. That's what it looks like to me.
Yes, or another way to put it is they put zero value on the current operations of BKW, being the brickworks part and the development part, and they're
pretty much
essentially giving no value to that side of the business whatsoever.
Pretty much. That's what it looks like.
Another way to put it is you can buy BKW right now for $2.5 billion.
Mm-hmm.
And you get their operations, cash, and all of their assets from their own business operations for free. Does that make sense?
Yeah, that makes sense.
So this is a potentially massively undervalued situation. So
how do we go further?
Let's dig in. Okay, so when they break out, when a company has different business segments and they break out those business segments, you can essentially put a value on the building products segment because they give you the EBIT right here. So you can do this a number of different ways depending on what you're looking for. What I would look for here is I would essentially just do a quick EBIT valuation of this.
8 times.
Yeah,
EBIT?
about 8 times EBIT.
Be conservative.
Yeah, so I'd put a value on this side of the business of about 608 million AUD right now.
Okay. Building product performance. I think that's the brick performance.
18. That makes sense.
Yeah, that makes sense. They have quite a lot of segments. They go for the annual report. Man.
Okay. I'm just kind of scanning through this, see if I find anything of interest.
They probably like 5 or 6 segments, I think. There's
Okay.
property development segment and another one. It's a couple.
Okay, so right here. So building products, property, investments. So this is going to be fun. So once you understand, this is kind of where I talked about before about once you understand the basics of investment and value investing, you can value any number of things. So not only can you value this, you can value this, you can value this.
The investment is the SOL. That's the dividend they receive from their holding.
Right here?
Yeah.
Okay.
That's the dividend they receive. Yeah. That's
so,
not actually, that's more like. So
and we'll get to that.
Yeah.
But to my bigger point, you understand what I'm saying now? Does this kind of fully flesh out how you can value these individual segments for a company like this?
Yeah. So it's got building product and there's property. Is that the property development?
Yeah.
94 million.
Yeah, right here, property performance. Yeah, and this consists primarily, okay, yeah. So these property, BKW's property segment. What is it, 94? And normally I would kind of spread these out more, but I'm trying to go through these quickly so we can hit as much as possible.
Yeah. Time mode.
So 752 million AUD. Okay. So how would you value these? Would you value these any differently than the other things we just valued?
Well, they put an 8-time multiple on 123 million.
That's what you do?
Yeah.
Okay. Yep.
Which makes sense because you're going to put an 8-time multiple on the other businesses. Although I think it's worth significantly more.
Yeah.
Because that business is like a Warren Buffett. It's like a Berkshire Hathaway.
Then 23. Okay, I'm going to put an extra note here. You know why I put that?
But it also includes like a small stake in a coal mining company as well, the investment segment.
Okay, we'll get to that. But do you know why I put this right here?
So you don't double dip it, double count it?
Yes. So if I'm looking at this, say, months later or years later, I know specifically that this was their portion. So I don't have to kind of guess on if it was only 39.3% of the dividend, if it was the full dividend, what it was. So I specifically know for my analysis when I'm doing this, let's say I was to write an article about this company. So I know specifically for my analysis what it's from, and also if I look back 6 months, a year, 2 years, 10 years later, whatever the case may be, exactly what this percentage here was. Okay.
Oh, there's an interesting article I'll send you.
Okay.
about this business. So what it is this company BKW owns 39.3% of SOL, and SOL owns like 44% of BKW. So it's like a cross shareholding, and then it's sort of like prevents like corporate raid and takeover. But then shareholders had tried to get this company, the other company SOL, into court to unlock the value. I think it was about half of 454 million dollar worth of value that could be created if they merge.
Yeah.
Yes, but they didn't. That's funny.
That's interesting. So, adjust the. Do those two lines make sense?
Yeah.
Right.
Are you double dipping here?
So, am I?
Well, you're adding all these different business segments. You've just added that plus you're double counting the BKW.
But what are we counting here?
Well,
when we count EBIT, what are we counting?
You count the building segment and the property segment, right? And the investment segment, which adds up to 2, 3, 4, 8.
Yes. So what are we doing when we count EBIT though? What are we valuing only?
The earning.
The operations.
Yeah, but its investment segment is not really their operation.
Yeah, I know, but they get this value.
All right.
Because they still get paid that dividend, they still get to use that as cash flow. Correct?
That is true.
So what I would do here, and again, this is probably out of the norm for some people, for many value investors, what I would do is I would add the actual value of the market cap of the stake to this value, because to me, you're not double dipping. Because here you're just valuing the operations here, but here, this is the actual stock holding of the company. Does that make sense?
Mm-hmm.
So, plus 2. So I get a value. Does that make sense?